Hey folks, Dan Frio here, the rate update. Today's October 9th. Happy Friday to everybody. I just noticed my head looks like lopsided. I don't know. Whatever. What happened to rates today? Don't go away. I'm going to go over that in 1 minute. We did it. What did we do? Thanks to you guys. Look, we did it. Thank you. I can't thank you enough. And our pipeline is full to the max. So thanks guys for watching the videos, paying attention, reaching out for us for help. And today we got another like 10, 15 applications, and I got about 4 loan estimates in today that I'm working on as we speak. So what we're gonna do today is Happy Friday. I want to go over what's going on with rates today. Really nothing there. I'm going to go over my rate sheet, but I want to go over, today's going to be educational because I'm going to go over a particular, I got a rate sheet from a competitor today, and I blanked out all the information. I want to show you guys how complicated a rate sheet is. And you might say, well, you know, basically the whole point here is there is so many different pluses and minuses to mortgage rates that I want you guys to get it for when you call a mortgage company and you say, hey Dan, what's your, or hey whoever, what's today's rate? If they tell you, they say, oh, 2.99, hang up on them, please, because they're not telling you the whole truth. They're going to tell you a rate, and then they're going to say, you know, and then when it all comes down to it, I can almost guarantee you're not going to get the rate that they're going over with you. So we're going to go over that right after the news. So let's get on to it. What's going on today? Securities, they are down 8. Not really enough to move our rates. We did not change rates today. So that is great news so far. But what I want to do is go through some technicals for you because I'm going to stop going long-term. If you guys want some long-term trends and things like that, let me know. Maybe I'll do a specific video for that, maybe once a week, just to get you what the outlook is. But I don't know if you paid attention. This just went from -3 to -2. Okay, so we are live right now. This is October 9th. My time right now is 3:03 Central Standard Time. And remember what I said here. Okay, so let me go through this for the newbies right now. Well, why do we follow this number? What is UMBS? Basically, we're going to chunk out the U and go to MBS. That means mortgage-backed securities. Okay, this is a bond that trades that is the biggest factor, and I'm going to get to this a little bit later when we go over loan level price adjustments. But this is one of the biggest components that creates or determines mortgage rates. Okay, this is the price of that bond. As I always say, when we see red, as we saw right now, bad, that's bad. Mortgage rates are going up. There's an inverse relationship. So when we see this number go down, it means rates are up. When we see this number go up, rates are down. Okay, so that's what we're following right here. So that being said, we want to watch the trend. Let's do a short-term trend here. Let's just go maybe about a month out. And what I was always saying is the Federal Reserve, their whole goal here is to take out volatility, okay? And try to keep things as stable as they can. They're doing a fantastic job, and there's a couple things I'm going to show you in here to basically prove that. And this also backs up my prediction. I don't think rates are really going to do anything. They might trickle up a little, might trickle down a little. There's much more of a potential right now for rates to go up than they are down, and I'm going to show you that here in a second. So all these lines, I'm going to go through this real quick. There's a ceiling. A long-term ceiling right here. These are these red lines. A short-term ceiling, a short-term floor, a long-term floor. Okay, so we're gonna focus short-term right now. So we're gonna just dig in right in through here. All right. So more components involved, and I'm gonna break down a little bit even more. Is we're gonna start watching the 25-day and the 50-day moving average. Again, we're gonna look. If you're watching this video, most likely you're looking to buy a house. You're a realtor. You want to be able to kind of give your home buyers some education on what are rates doing. What are rates doing in the past? You know, what do we expect in the next maybe 30, 60, 90 days? Okay, so that's what we're going to begin to focus on. All right. So that being said, here's some lines that we're going to follow. Okay, my line is a little bit off, but these these indicators right here, this is what we call a 25-day moving average and a 50-day moving average. And it's the line right here and the line right here. Okay, so we follow those, and that's putting us to right here. And the other one is following us, putting us to right here. So do you get where I'm saying? And I did that a little long term, but we should be trading right here because everything is pointing there. All right, so in the shorter term, in the next week or two, we should be stagnant right in here. It might move a little bit up and down through here. All right, so again, you got to watch. Here's the ceiling. This is a resistance level, and then here's the short-term floor. We're a little bit over the middle part of this up here. So there's if the rates go up, they're going to go up a decent amount. If they go down, there's not as big a trend to go down. So again, to recap this whole thing, there shouldn't be anything that should affect this. However, there's always a however. The next week we're getting some information out, and the things that could shake the market right now, I'm breaking it down into three different things. Inflation. So the inflation numbers are coming out next week, and that is the CPI, is what most analysts and everybody else follows, and the PPI. And that's inflation indexes that the Federal Reserve monitors. Those are coming out next week. It could create some fluctuation in the markets. If you start seeing inflation heat up, and there's a reason why that might happen, you could see an uptick with mortgage rates. Okay, the inflation, where I'm concerned right now with inflation, is the logistics part of the economy. Logistics is shipping. There are tons and tons and tons of people ordering everything online. And it's, so when you order online, it has to be shipped one way or another. Shipping prices have almost doubled recently, putting pressure on pricing. So what the vendor is, they have to increase their prices because shipping prices are increasing, and there's probably not that big a margin in a lot of the stuff that you're buying. So prices are going to start to tend to go up some, and that is inflationary. Okay. The next thing I want to talk about is the stimulus package. Now, one day we're having a stimulus, the next day we're not. The next day we are, the next day we're not. Now, today they came out and they might have a $1 trillion or $1.4 trillion stimulus package. It is all about right now to stimuli or not to stimuli. And that is like flipping a coin, and where are we going to be? So that is also an area that could cause some havoc in the next week. And all this is kind of transposing in probably in the next week or two, because from there on, we're darn near at election time, okay? And the next thing is, and this could be big, forbearances. And I've been preaching to everybody what forbearance is. So let me go over forbearance and why this could cause some big issues. Forbearance is, when you hear about forbearance, if you're a homeowner, it's, you're able to skip 3 or 6 mortgage payments. Let's revise that skip. Let's change that word with postpone or kick it down the street. Okay? So now, coming very soon, the forbearances are starting to take effect. And it depends on what you did, if you got a forbearance, how you're going to be affected. Most people, and this isn't in the news, and you're probably going to hear this in the next couple weeks, if not month, and mark my word, it's going to happen, is they went in and they called their lender and said, I want that forbearance agreement. To be honest with you, I even called my lender and said, because I'm like, heck, if I can avoid 3 or 4 mortgage payments, I'll skip 3 or 4 mortgage payments. But what I found out, as well as some of the attorneys I deal with and accountants I deal with and a lot of customers I deal with, what was happening is that, when you dig into it, they come back and say, well, it's not really that. It's we'll let you not make the next 3 to 6 mortgage payments, but then once that duration of time goes through, you have to bring your account current. So let me rephrase this. So let's say right now you went in and you got the agreement and it was in June. So now they say, well, you can postpone, not skip, postpone June, July, August, September, October, November. Your 6 months or your 6 payments. Come December, you open your mortgage statement and you're like, this is cool. I haven't made a mortgage payment in 6 months. You get a bill for about $20,000. What? Well, you have to now in December make June, July, August, September, October, November in your December mortgage payment to bring yourself current. When that happens, I'm sure people haven't put this money aside. People are going to freak because I can almost assure you nobody put that money aside. Mortgage delinquencies could spike. Major. I mean, there's hundreds of thousands of people in forbearance. I warned everybody back several months ago, please do everything you can not to take the forbearance agreement. Now, some people got fantastic deals. They threw the balance on the end of the loan, so forth. You're paying interest on it, but whatever. But if that saved you, God bless you. But if you just kick that can down the street, you're going to be, there's a rude awakening coming soon. So reach out to us. We'd love to help you when it comes to that situation. If you're in there, maybe we can give you some guidance there. Okay. So those are the 3 biggest components that I see that could majorly affect the markets right now. I go over this every day. I'm going to post this. It goes over what the average rate is for a 30-year conforming, a 30-year jumbo, FHA, and VA. There's really, the conforming rates didn't really move. They're saying the jumbo rates went down 4 basis points. That's just 4. It's like on this would be 3.05. That would have been yesterday 3.09. Okay, so that's the 4 basis points moves out two to the left of the decimal. FHA was down 2 and VA was down 1. Okay, this is purely generic. And like I said, what I'm going to show you next is an average rate sheet that mortgage lenders produce. And you're going to be baffled. I can almost guarantee you. So let's get to it. Okay, so here we are. This is an average rate sheet. And I'm going to try to make it as simple as I can, but it's harder than you think. Okay, so if you look at this, it goes through, this is a Fannie Mae, so a conventional rate sheet. And then you have different areas here, which is a 30 and 25-year term, a 20-year term, and a 15 and 10-year term. Okay, that gives you these sections up through here. Now over here, we have what your rate would be. So you see it says rate, and then you go down through and there's all kind of different rates. All right, so that being said, this rate right here, so 2.625 would be the rate. And now you have, if you were to lock in this rate, you have a 15-day rate lock, a 30, a 45, a 60, a 75, and a 90. If you follow my channel all the time, there's a lot of this that would make sense to you. If you don't, it's going to get a little confusing, and I'm going to try my best to explain this. Okay, so right now, you could get a 2.625 rate and lock it in on a 15-day lock, and you would actually get 0.96 back in a rebate or a credit back to you. That's how a lot of companies do, no closing costs back to you. Okay, so let me put this in its simplest form. Why, Dan, where did you come up with the 0.96? Well, 100% is, we call it par. So at 100%, we start at 0. Okay, 0, what I mean by 0 is you can get that rate and it wouldn't cost you anything. Okay, anything that goes below 100%, so let's say, for example, you can get 2.5 and it was 99. Okay, remember, our par or our benchmark is 100. So if you're at 99, to get you to 100, it is 1 point. Okay, so you would have to pay 1 point, and I'll plug it in here just so we can kind of get to that. All right, you would have to pay, we got to get this to 100, remember, you'd have to pay 1 point to get to 2.5. What is 1 point? That's 1% of the loan amount. So I always use factors of 250,000. So if you wanted 2.5, you'd have to pay $2,500 to get that rate. Okay? As we move up, you're going to see numbers getting more positive. Any positive numbers is a rebate check back to you for that amount. So for example, at 2.75, you would get 1.915 in a rebate check back. Again, our loan amount that I always use is $250,000. 1.915% a rebate would be you would get $4,787 back in a rebate check, or that could cover all of your closing costs. Okay? So, and it moves up, and you just do the same with all this. As you can see, we have different variations of rate locks. And what the rate lock means is once you're locked, your loan has to be approved, closed, and funded by time this time frame expires. Okay? So you can see at 2.625 on a 15-day, you're getting back 0.96. On a 30-day, you're getting back 0.48, and then it kind of goes from there. I don't know why this is higher than this. That makes absolutely no sense. This isn't my rate sheet, but I'm just going with it. So you can see, as you go out in time, that rebate gets less because it's more expensive for us to lock in your rate for a 90-day time period than it is for a 15-day time period. So what we do is we hedge our money. So let's say you're getting a $250,000 loan. We go out in the market and we hedge. We take $250,000, we set it aside in our account. So when we close your loan, we have the money there. Okay, that's the easiest way for me to explain it. So that goes through all these details. Okay, so there's all the rates, all the premiums, and all the adjustments. Now, here's where it gets tricky. Remember I said the MBS market is one of the biggest determinants of what your mortgage rate is, other than loan level price adjustments, meaning risk factors in the loan. Okay, so now let's go down to those loan level price adjustments. And this is where it gets kind of confusing, price adjustments. So now here's where your credit score comes into play. So let's say, for example, you have a 620 credit score right here. You're going to see where this says -5, -1.5, -3, -3.25. Well, look up through here. This is your loan to value. So the higher your loan to value, the riskier it is. So it's giving you a -3. Well, what's that -3 mean? Well, you got to go back up to the top, right in here. And now whatever this number is, now you have to take 3 points away from it. So you're thinking, well, I can get a rate at 2.625 and get me some money. No, because now we have that -3 because we have a lower credit score. So we actually have to move up to here. So now your rate is at 3, getting 3 rebate back, but we deduct this 3 from down here, right here, to this number, and that now brings us to 0. I hope you get it. There's more. So now we go back down to here, and let's say, for example, you're at an 80% loan to value with a 620 credit score on an investment property. Okay? So let's figure out what that rate's going to be. Well, we got a 620 credit score at 80% loan to value. We -3 there, so we have to deduct 3. We're getting cash out. So we go back down to this cell, and you're down to another 3.125. And then you go to an investment property, and you lose another 3.375. So now what do? We have to take 3 plus 3.125 plus 3.375. Now we're at -9.5. We scroll back up to the top, and we got to figure out where's the 9.5. So we're looking at 109.5. Doesn't exist. So this loan, we'd have to go all the way to the top at 4.125. We're at 4.6. We have to minus 9.5 from there. So basically, you're 5 points underwater. So it would cost you 4.125 plus 5 points on a $250,000 loan. That would be $12,500 in points. You get it? I know it's confusing. So we go down here, and that's what I always say. There's loan level price adjustments. I need to know what your credit score is, what your loan to value is. Are you looking to pull out cash? Is it an investment property, a 2-unit, a condo? What are we looking at here? All these factors go into it. And then there's even more down through here. I'll stop there because I probably have you completely confused. So now you can see when I post my rates, I try to make it as simple as I can just to educate you guys on how different credit scores and different loan to values, different terms, if it's cash out or rate and term, how that affects your rate. That's the whole point of this this tutorial, I guess, is the best way to do it. So my rates haven't deviated from yesterday. They're the same, and I'll go through those with you real quick right now, and then we'll end it at that because your brain's probably thumping, but I hope you get it. And if there's some more details you want me to really dig into, I'd love to do that for you. So right now today, my conforming, or what we call conventional mortgage rates. If you're looking to purchase a home or do a rate and term basically means you're just changing the rate and term on your current balance of your mortgage. Okay, that's it. We're not looking to pull out any cash. On a 30-year term, 740 credit score right now at 80% loan to value. Your rate would be 2.875. APR is over here, 2.952. 700 credit score at 80% loan to value, 3.125. 660 at 80%. You can see those loan level price adjustments are affecting us now. You're at 4.125. If you're looking to cash out, 740 at 75% loan to value, 2.99. 700 at 75% loan to value, 3.375. And 660 at a 75% loan to value is 4.625. The basis here is, or what numbers I'm using to create these rates, is a $250,000 loan. What this number here is, when I say loan to value, it is basically the loan amount divided by the value of the property. So let's figure out what this one is, just so I can make this clear for you. So at 80% loan to value, we know our loan amount is $250,000. So what would the value of the house have to be at 80% loan to value? So we take $250,000 divided by 80%, means your house would have to appraise for $312,500. Okay, so that's the criteria behind this. Now let's move on to the 15-year rates. And on a 15-year rate, the top section is purchase rate and term. 740 credit score at 80% loan to value is 2.375. Same rate at 700 credit score. If you had a 660 credit score, your rate's 2.5. Cash out, a 740 credit score at 75% loan to value, 275. 700 credit score, 2875. 660 credit score, 3.125. Again, see, there's a higher rate because the loan level price adjustments, the risk is hitting it here and pushing that rate up from 275 to 3.125. Now let's get into our government loans. Our government loans are FHA and VA. Our FHA rates today. Most people, if they're looking to do an FHA loan, they're either purchasing a home because it's minimum down payment and you might have a credit score that's kind of in the mid-tier to lower tier, gets you a much better rate. And FHA loans go up to 96.5% of the home's value. All right, so a 740 credit score at a $250,000 loan at a 96.5% loan to value, rates 275 with an APR of 3.01. 720 credit score, same rate. 680 credit score, same rate. And now the loan level price adjustments start to kick in once you get down to the lower 600s. So to 620 credit score, the rate goes up 1% to 3.75. My VA rates are the same. But the difference between VA, when you have to be an honorable discharge veteran, is you can go up to 100%. You can go up to 100% financing if you're looking to buy or refinance your home or cash out. And those rates are the same as my FHA rates. So here's your rate, here's your APR. Our jumbo rates are basically the best in the country, and I'll leave it at that. If you're looking for a jumbo loan, you're looking to buy or refinance your current loan up to 75% loan to value. The rate on a 780 credit score is 3%. 760 is 3.25. 740 and 720 are both at 3.375. So those are my rates for today. So now you're like, Dan, this is awesome. But what do we do? Okay, so here's what I suggest everybody do. If you'd like to get involved and get us to help you buy a home, refinance a home, figure out how we get you out of the forbearance agreement, anything when it comes to the mortgage, please, the best way to do that is visit our website, therateupdate.com. I'm going to go over that in a second. But what I ask a lot of people to do, or most people, is if you're in the process right now, you get a loan estimate or a fee worksheet from your current lender. Get a second opinion. Please get a second opinion. Email me that loan estimate or that fee sheet. Let me write all over it in red pen, and I can tell you what I can or can't do. Almost every time we're beating the competition. And some of them, it's crazy. I had about 5 this week that we were beating the competition over $8,000 in fees. $8,000. That's a lot of money. So the best way to send that to me is email it to me. My name is Dan Frio. I do the rate update, as you know, every day. You can reach me at dfrio, which is Frio, at preferredrate.com. So let's get to the website right now so I can show you where to go and how to get there. Go to therateupdate.com. That's right here. What you do is, if you want to call in, we got an 800 number. You can reach us at 844-775-LOAN. That's 844-775-5626. Or like I said, you can email me at dfrio, which is D as in Dan, Frio is Frio, at preferredrate.com. You can just hit the apply now button and get the ball rolling. And if you haven't started the process yet, and you're just like, Dan, what can you do for me? I suggest you do this. Send me a copy of your mortgage statement, okay? Send me a copy of your mortgage statement. Just email that to me. Your statement is basically going to give me mostly everything that I need. It'll have your name and address. So with that, I can Google your address and try to figure out what the value of the home is. Your mortgage statement it'll give me the balance you currently owe on your mortgage and the rate and your escrow and a breakdown of all the numbers. I'll do it on my end. I'll create, a game plan for you, and I'll get back with you and say, here's what we can do. So you might be looking to do one of a few things. Is you want to keep the payment the same? We could probably shorten your term, save you a ton of money in interest. You might want to say, Dan, I just want to get through this mess right now, save as much as I can, take me back to a 30-year term. Rates are so crazy low. I'd rather finance more at a 3% mortgage than pay a credit card rate at 20%. So we move you back to a 30-year term, get your finances straight, and then maybe start paying extra each month on your mortgage to get that paid off as quick as you can. There's multiple things you could do, but I just ask you, we can't help you if you don't reach out. So that's all I got for today. God bless you. Thanks. We hit 10,000 subscribers last night. Thanks to you guys. Hopefully we can get to 20,000, 50,000, $100,000, 100,000 clients by the end of the year. But that's only up to you guys. So thanks. God bless. Have a great weekend. Be safe. Be happy. And I'll see you on Monday. Bye-bye.